Stop looking at your chart patterns for just 30 seconds. Thousands of traders out there are scrambling to find the perfect gold entry point, chasing signals and gambling on pips. But while they're busy drawing lines, they're missing something massive. The largest wealth shift of the decade is happening right beneath their feet. Gold has been rallying, and the noise on social media is deafening. Everyone is asking, is the bull market back? Where should I buy? But if you're treating gold merely as a ticker symbol to trade for quick gains, you're missing the bigger picture. In 2026, gold isn't just a commodity to speculate on. It has become a structural asset in a crumbling global game of geopolitics. What we're seeing isn't just market volatility, it's a systemic realignment. Today, we're going to strip away the technical noise and look at the real data, because the true trade isn't on your charts, it's in the macro. So why are we so obsessed with the perfect entry point? If you look at the landscape of financial content on YouTube right now, it's a factory of signals. Every day you have analysts dissecting charts, measuring Fibonacci retracements down to the decimal, and promising you that the bulls are back or that a massive drop is imminent. They show you screenshots of massive gains, 400 pips, 750 pips, and they tell you to join their private Telegram group to get the next golden ticket. And honestly, I get it. It's seductive, it's clean. It feels like a video game where if you press the right buttons, if you buy at the right support level and sell at the right resistance, you win. It's the day trader's trap. But here is the harsh reality that these signal peddlers won't tell you. A chart is just a rear-view mirror. When you base your entire trading strategy on pure technical analysis, looking only at support lines, candles, and pivot points, you're essentially driving a car at 100 miles per hour while only looking at the map from last week. Sure, the patterns look familiar. They always do. But the market isn't a static machine. It's a living, breathing creature driven by capital, power, and panic. Think about the recent volatility in gold. You might see a rejection at a key support level on your daily chart and think, this is it, time to go long. And maybe, just maybe, it works once or twice. But what happens when the actual catalyst for the move isn't a line on a chart, but a headline from a geopolitical crisis in the Middle East or a sudden shift in policy from the Federal Reserve? When the macro environment shifts, technical levels don't hold, they break. And when they break, the traders who were so confident in their perfect entry points are the ones left holding the bag, wondering why the market didn't respect their Fibonacci levels. By treating gold like a simple puzzle to be solved with a ruler and a marker, you're missing the forest for the trees. You're trading the price, not the value. You're trading the emotion, not the reason. And in a market that is increasingly dictated by institutional players and central bank accumulation, betting against the fundamental tide just because a chart looks good isn't trading, it's gambling with a fancy interface. If you want to survive and thrive in this environment, you have to stop asking, where should I enter? And start asking, why is the money moving here in the first place? Because once you understand the why, the where becomes a whole lot clearer. And that is exactly what the people selling you these signals are rarely interested in teaching you. So if technical charts aren't the whole story, then what is? To understand where gold is actually going, you have to look at what the smart money, the central banks and institutional giants, is doing while the retail traders are busy betting on pips. If you think gold is only rising because of the war, you're right, but you're not seeing the whole picture.
War is just the catalyst. It's the smoke, not the fire. The real thing happening, the fundamental shift, is a calculated flight from the instability of global monetary policy. Look at the latest Q1 2026 data from the World Gold Council. There is a massive structural change happening in the market. We aren't just seeing a spike in jewelry demand, which is typically driven by culture or temporary trends. We are seeing a historic surge in the demand for gold bars and coins. This isn't consumption. This is capital preservation. When people start trading their cash for physical bullion, it's a red flag, or rather, a gold flag, that confidence in the fiat currency system is beginning to crack. But it's not just the individual investors. Look at the central banks. They're buying at record highs, and they aren't doing it because they're following a chart. They're doing it because they have access to the data that retail traders don't. According to the latest World Bank Commodity Markets Outlook, the conflict in the Middle East has created a profound shock to global supply chains. We're talking about energy costs, fertilizer, and the basic movement of goods. When the World Bank warns of supply chain disruptions, they aren't just talking about shipping delays, they are talking about structural inflation. Here's the dilemma. The Federal Reserve and other major central banks are trapped. If they keep interest rates high, they choke growth and risk a systemic debt collapse. If they cut rates too early, inflation roars back to life. This is the monetary instability that I mentioned earlier. The institutional players, the sharks of this market, see this trap. They see the debt-to-GDP ratios of major economies. They see the instability in the Middle East, and they understand that the traditional 60-40 portfolio, stocks and bonds, no longer offers the safety it once did. Bonds are vulnerable to inflation. Stocks are vulnerable to economic slowdown. That leaves one thing: gold. When you look at it this way, gold stops being a volatile trading instrument and starts acting like the ultimate hedge. Central banks are loading up on gold, not because they want to profit off a price swing, but because they are diversifying away from the US dollar and other fiat currencies. They're voting with their balance sheets, and their vote is telling us that the next decade of monetary policy will be anything but stable. So when you see a dip on your chart and you're paralyzed by fear, remember this: while you're watching the candles, the biggest players in the financial world are quietly accumulating physical assets. They aren't worried about whether the price drops 300 pips this week. They're worried about what happens when the global supply chain, already fragile from geopolitical tensions, faces another shock. They're positioning for a world where gold is the collateral of last resort. And if the smartest, most well-informed entities in the global economy are prioritizing protection over profit, why are you still treating gold like a lottery ticket? So, where does that leave you? We've dissected why the charts are misleading and why the institutional giants are quietly accumulating. Now we need to address the most critical shift of all: redefining what gold actually is for your portfolio in 2026. Stop thinking of gold as a speculative trade. Start thinking of it as a structural asset. What do I mean by that? A speculative asset is something you buy because you hope it goes up next week. It's a tool for quick profit, a way to leverage volatility.
But a structural asset, that's something you hold because it creates the foundation for your financial survival when the system wobbles. Look at the central banks again. Do you think they sit around waiting for a technical breakout on a daily time frame? Of course not. They aren't day trading. They are building a structural position for the next decade. They are hedging against the systemic devaluation of the very currencies they issue. When you realize that, the entire trader mentality starts to look, well, a bit childish. Stop chasing the pips and start positioning for the reality of the economic cycle. If your entire strategy relies on a technical entry, you are fundamentally vulnerable. If your strategy relies on understanding the intrinsic value of an asset that stands outside the traditional banking system, you are resilient. In 2026, the world is shifting away from the business-as-usual model we grew up with. Geopolitical friction isn't a temporary glitch, it's the new baseline. Energy insecurity, supply chain breakdowns, and the constant threat of monetary debasement aren't just headlines. They are the tectonic plates of the global economy moving beneath us. And in a world of high debt and unstable fiat money, gold isn't just another asset class. It is the insurance policy for your financial house. So here is the challenge I want to give you. Stop looking for the perfect entry point based on a random line on the screen. That is a trap that keeps you focused on noise rather than value. Instead, look at your portfolio and ask yourself, do I have the structural foundation to survive the next shift, or am I just betting on the next candle? Being an informed investor doesn't mean you ignore the charts. It means you stop letting the charts ignore the reality of the world. Don't be the trader who knows the price of everything and the value of nothing. Be the investor who understands why the foundation is shifting and positions themselves before the rest of the market wakes up. Ultimately, don't let the noise of short-term pips and flashy indicators blind you to the bigger picture. Gold in 2026 isn't just another ticker symbol to trade. It's a story about trust, geopolitical security, and long-term defense. Those technical support levels that everyone's obsessing over, they only matter if the macro foundation beneath them remains solid. Without that, they're just lines on the screen. So I have to ask you, when the financial system hits its next inevitable wobble, what is your position? Are you holding gold just to scalp a quick profit and chase the next entry signal, or are you holding it as a structural asset to protect your future? The market is shifting. Stop betting on the noise and start understanding the narrative. Let me know your take. Where do you see gold fitting into the global puzzle in 2026? Drop your thoughts in the comments, and don't forget to subscribe for more deep dives into the macro reality. See you in the next one.